Hi everyone and welcome to this new video. This time we'll be talking about HTA ETF, which is the Harvest Tech Achievers Growth and Income ETF. So this ETF is a covered call ETF that gears towards investors who are income oriented, but also who are interested in some growth because the focus here is the tech sector. So far, HTA has been the best performing covered call ETF in its category. And we will here discuss the investment objective, the and the strategy that is being used to generate the attractive yield that they are posting, which is around 10%. So if you go here to the website of HTA, which is the Harvest Tech Achievers Growth and Income ETF, you will find that the focus here is tech stocks. So when you invest in this ETF, you have all the players, the big players in terms of innovation, and also in the big names in the tech sector overall, and mostly it's large cap companies. So we're talking here about blue chip established companies in the tech sector. So it's a great way. Let's say, for example, you would like to invest in tech stocks, but you're not sure which one to pick. And also, you're very worried about the volatility that is usually tied to these tech companies. Then a covered call ETF here plays a good is a good strategy if you're conservative. It's a good strategy because once you will all get the distribution yield, which is around 10%. So that's a nice income there. And the second thing, you get also capital appreciation, a portion of the capital appreciation. And when there is a decline or a market correction, you're less hit because of the covered call strategy. When the market is up, you will get some of the potential growth. And personally, a covered call strategy, the definition of it, which is using options to generate income and limit volatility, works best in the tech sector. And that's like it's a fact. So what they're trying to do, like a lot of issuers, they're trying to bring covered call to various sectors and make it diversified. It doesn't work as much as when it's applied to the tech sector, because the tech or gold or oil, because these sectors are volatile, so it's easy for the manager to get to benefit from the volatility. And from to benefit from the volatility, it's much easier, and it can be also applied only to a portion of the portfolio instead of being applied to 50 or higher to get premiums. Here in this case, the covered call option strategy is applied to 33% of the portfolio. This is obviously an approximation. They can go up or down based on market factors. But because of the high volatility of the portfolio, they're using it only on 33%, and it's enough for them to generate an attractive yield. And you capture the growth of the remaining 67%, because the 67% of the portfolio here will you will catch the potential growth uh, of that section, and the 33% will help you just get the that income and get portion of the capital appreciation. So it's a good balance, and it works best in a tech sector versus applying a covered call strategy like we're seeing now. They are offering covered call that are diversified across sectors and all that. It doesn't work as best when it's just applied to what it's used for. Options are used for volatile stocks and tickers, not for a consumer cycle or things like or banking. Or it's used really when there is high volatility, and it works best. And also, it's when there is high volatility in a sector, you're kind of that the yield will always be interesting because there is always volatility, because these yields are variable. They're based on options, right? So if your ETF invests if your covered call ETF invests, let's say, in low volatility stocks or some things like that, you will notice that the yield will decline when market conditions are not favorable anymore for options, and when there is less volatility, all that. But the tech sector, generally speaking, is highly volatile. It's followed by the market. Any news about Google or anything like that will cause volatility within the portfolio. So in my opinion, covered call strategy works best in the tech sector, and this ETF is a great way to have that exposure with less volatility and gain some attractive yield there. And so that's for the overall view of the HTA. You could see here that because tech sector has had a great run so far. Like in the past year, you would see that for a covered call strategy, ETF, you have really a great potential growth here. Because usually with covered call ETFs, a lot of people are witnessing decline in their uh, price of their ETF that they bought. And that's because the covered call strategy, if it's applied to sectors where there is really low volatility, it doesn't work as well. So here, because the tech sector had a good run, the person who holds the ETF gets the attractive yield of 10% and benefits from the growth of the tech sector, obviously less than someone who holds directly though that tech ETF without covered call, but still, like, you're getting less volatility and more and some return, and in a plus in the distribution yield. So it's a good mix between risk and return. So it's what you want versus someone who just doesn't want the yield or the distribution yield and want the full volatility, full growth. So that person takes more risk than you when you invest in a covered call ETF. So he would have more return. It's understandable, but you would see here that you're getting a fair share of the capital appreciation when the tech companies are doing well, and also you're getting that attractive yield that you need as an income investor. In terms of historical performance, the in 5-year average has been 15.82, which is really great. This is the annual average return. So on almost on each year, you have almost 16%. On a 3-year average, it's 12%. Year to date, it's 34% because of how tech companies have really well performed lately. And if you look at any covered call ETF that are out there, you would notice that they are nowhere near this. There is a lot of capital erosion because they apply the strategy into sectors that don't have high volatility. So it's something to consider when you're using covered call ETF. It should be, if you are interested in dividend and you just want dividend from banks and consumer basics and consumer cyclical companies, just buy a regular dividend ETF. You don't need to go a covered call ETF for these sectors. But if you're looking to invest in the tech, but you're worried about the volatility, a covered call ETF is a good blend there because you have less volatility and the distribution yield that you want, right? So here it's around 10% at the time of this video. Usually covered call ETF, when there is a bear market, they tend to outperform because the options protect them. Not a lot of protection, but still protects you from bear market. Range bound market, they tend to outperform a regular ETF, and also in a moderate bull. But in a powerful bull market, you will underperform the person who holds a pure tech ETF, no covered call. So they will have more return than you do because you have a covered call strategy being applied to your portfolio. In terms of MER, it's a 1%, so it is a little bit high, but that's the MER, the management expense ratio. I actually don't have the comparison with maybe similar ETFs who are in the tech, but the MER here is 1%, the last published MER. You would notice here, this is the price, so it trades at 14.76, and it's issued by Harvest Portfolio Group. It's trading right now at 1476, and it's close to its 52 weeks high, which is 1588. The 52 weeks low 1112. So you can see here the range is still somewhat stable, like it's not a big like a huge volatility. And it does pay a monthly dividend on a monthly basis, and it's around, as I mentioned, around 10%. And the holdings, you have various sectors. You have software companies, semiconductor, interactive media. So it's really a good blend of technology companies. And the portfolio is the biggest share is to Alphabet, 5%, ServiceNow, Adobe. So it's really interesting companies who are in the technology sector, and it's a diversified portfolio, and they are all large cap and usually blue chip companies. You have here Facebook, Microsoft Corporation. So overall, it's really a quality portfolio, and the covered call strategy works well with tech stocks. So the only issue is probably the MER, that it's a little bit 1%. But I saw like other ETFs that have a lousy performance and the MER is around 2%, like other covered call ETF, and the MER is really high, around 2%. This is reasonable compared to other ETFs I saw. But again, it's just a question of marketing. Some other ETFs are like, oh, well, this is super diversified, blah, blah, blah. When you go to covered call ETF is to avoid volatility, and volatility exists only in certain sectors. So it's better just to focus on those sectors and get a covered call ETF for those sectors. You don't need a covered call ETF for sectors that are not volatile. It doesn't make any sense. So I hope this video helped you out regarding the if you were looking to invest in HTA, and have a great day.